I'm Charlotte McLeod with the Investing News Network, and here today with me is Gwen Preston of Resource Maven. Just a reminder before we get started that if you enjoyed this interview, don't forget to hit the like button and subscribe to our channel. Gwen, thank you so much for being here with me today.
Oh, thanks for having me.
Yes, excited to talk about gold and hopefully some other commodities as well. But starting off with gold, which has had an interesting year so far. I know some people were disappointed to see it going down in the months toward the beginning of the year. We've seen it go up recently, even getting above 1900 per ounce in the last couple of weeks. For you, I wanted to ask, in the past, you've emphasized that negative real rates are the most important factor for gold. So to start off, I wondered if you could explain gold's price movement this year in that context and what we should know about that.
Yeah, for sure. Great question. I mean, it is negative real rates are the thing that move gold. Once gold has become part of a larger sort of commodities bull market, then there are other things that also feed into it. But to get going, what gold needs is a fundamental argument, a fundamental reason for people to want to buy it. And that reason is negative real interest rates. And the reason that that's so important comes from a few angles. The classic explanation is that when real interest rates are negative, so that's like usually you think of it as the yield that you get on the 10-year treasury minus inflation. So if you were to just hold a 10-year treasury for 10 years, if inflation's actually going to steal all the yield that note would pay you, then you're actually paying the government to lend them money, and that's a negative real rate. So that's the argument. Whenever real rates are negative, that means that it doesn't pay yield wise to own things like treasuries. And of course, there's a curve, and shorter terms pay different amounts than longer terms, and there's complexity there. But when real rates are negative, it does disincentivize people from owning those treasuries. Of course, there's a whole other market right now that needs to own those. Banks are buying them and the Fed is buying them. So it's not like we're short on treasury buyers, but people are a little disincentivized to own treasuries for yield. And so they look elsewhere. The other thing though, is the kinds of environments in which negative real rates happen. Why are real rates negative? And it's because we have interest rates, as per what the Fed sets, slammed down to zero to really encourage growth in this post-COVID world. And that growth is starting. It's definitely starting. And we're seeing that in inflation numbers. And so when you have zero interest, when you have interest rates at zero and you have inflation that is real, then you're in a negative real rate environment. Now, you mentioned that people were a little bit dismayed at gold's performance, from an amazing high in August of last year through to, I don't know, a month or two ago. And it did do a big slide. What happened there is that the 10-year yields on treasuries started to move. And that has everything to do with inflation expectations. And so people were expecting inflation to go, and that increases yields. That's like the mechanics are that increases yields. What was odd though is that happened before inflation actually showed up. So I kept saying late last year, this will all correct itself once inflation actually shows up. And when it does, then bam, everyone will realize that what really matters is the negative real rate environment. Before inflation showed up, it was very difficult to know what real rates were because there's only two parts to the equation. There's interest rates and inflation, and we didn't know what inflation was. Like, it was a weird, very transitionary thing. Now it's here and it's real. And the numbers that showed up last month were like, whoa, way higher than anybody expected, and not because of year over year effects. They were way higher month over month, like expecting 0.2 and getting 0.8. That's a big difference. So when inflation shows up, it says growth is happening. And as long as the central bankers of the world are not thinking about raising interest rates, which is still the situation that we're in, real rates remain negative, and negative real rates are the thing that push people towards gold. And as it turns out, gold is doing darn well. $1,900 is an amazing price. So then there's all these other factors that pull people towards gold. The main one being gold miners are kicking out money like you wouldn't believe right now. And so the setup is very strong. Gold miners are still undervalued. the argument for gold, that fundamental real interest rates argument for gold, is very clear now that inflation is really on the table. The Fed keeps saying that they are not going to raise rates. They keep saying inflation is transitory. There are reasons for saying that we won't get into right now, but in the moment, we see a negative real rate environment stretching out ahead of us for quite some time, and that supports gold. And gold miners are making tons of money, which encourages investors to rotate. And so things are really looking very good on the gold front.
Right. And let's talk a little bit more about inflation, which, as you mentioned, the Fed seems unconcerned about and kind of keeps brushing it off. What is your view on what we're looking at this year in terms of inflation?
Yeah, inflation's an interesting one. Hey, there's so many factors that feed into it. Um, I mean, like the main CPI inflation, the one that most people pay attention to, doesn't include fuel and food. This is just a for instance of how difficult it is for people to wrap their heads around what inflation is. Well, it's a really good thing nobody ever needs to, like, fill up their car or drive, right? So, I mean, the numbers that we have to try and estimate inflation, they are what they are. They should be modernized, but they are what they are. There's lots of reasons to believe that inflation is very real. I mean, the money printing side, that's a bit of a nebulous thing. But yes, there's been a lot of money printing, and a fair bit of that money has been handed directly to consumers. And so savings rates really went up during COVID. People couldn't travel, people couldn't do a lot of the spending that they might usually do, and they were being given stimulus checks. Certainly, some of those checks went to pay for needs, for sure. But savings rates absolutely went up. So there's a bunch of money, there's a bunch of pent up desire to spend, is probably the best way to say it, because we haven't been able to fly to Hawaii, or take a cruise, or even just go and watch a movie, things like that. So that will ramp up. And then the thing about inflation is also on the supply side. If there's constrained supply, and there's been a lot of supply chain disruption because of COVID, and so we're starting to see that as well. We're seeing labor issues, manufacturers, stores having trouble finding workers, for a variety of reasons, whether it's because stimulus checks are still encouraging people to stay home, whether it's because of fear of COVID, whether it's because of any number of other things, people retraining, goodness knows. There's a lot of forces that suggest that inflation is very real. It's really happening. The one that we haven't quite seen yet is wage inflation. And so that is something that I'm really keeping an eye on, because for inflation to sustain, we need people to be making more money so that they can continue to spend more money, because prices can't rise unless people are actually buying. But we're starting to see a touch of wage inflation. I think it's coming. So I do think we are going to see quite a bit of inflation. And of course, the Fed has made clear they're not just going to let inflation touch 2%. They're going to let inflation average 2% over a time frame that they have not clarified. So that means that it will have to go above 2% for quite a while, because it's been below 2% for an age, in order to get themselves to that average. So inflation, I think, is here, and it's real. I mean, how keen is everybody to spend money, right? We've all been stuck in our houses. I'm not complaining. That's just the reality. We've all been stuck in our houses, and I think people are pretty keen to spend money, and that's the kind of thing that causes inflation.
Interesting. And so, if we put all of this together in terms of the gold price, we know that it looks like it's going higher. Do you have a sense of how much higher it could get in 2021? And maybe another good question to ask is for you, how much does the actual gold price matter? You mentioned 1900 is still a pretty good level.
Yeah, so good. Yeah, that's a good question. I don't try to do gold price forecasts. I do think that the price, I mean, it's made a really lovely move in the last little while, like you say, getting above 1900. Usually it takes time to consolidate, confirm and consolidate major moves above technical and psychological barriers, and 1900 is certainly one of those. So I would expect it to consolidate around this level for some time, and that would fit with a seasonal pattern of being a bit more sideways in the summer. And then in the fall, I mean, I think we could see another big move. Does that take us halfway through the 1900s? Does that take us to 2000? I don't know. But I'm pretty bullish on this market. So I think in the next few years, as this gold market progresses, we're going to see gold above 2000. I'm pretty confident on that. And one of the things that makes me confident in that is that gold is not moving on its own. Gold is moving as part of a commodities bull market. And whenever you have a multi-metal market, that's a far stronger phenomenon than a gold only market, because gold has its naysayers, right? There's lots of people that think gold is just weird and doesn't deserve part of their portfolio. That's fine, to each their own. But when you have a broad commodities bull market and there's all these arguments for, you know, the dollar weakening and inflation in play and demand being high, and therefore risk being in the stock market and the need to diversify, all of these arguments come together and support commodities across the board, and gold gets to benefit from that as well. And so we have both of those things in play right now. So that makes me pretty confident in gold over the next few years.
Yeah, and definitely I want to come back to the broader commodity space. But before we go there, just want to take you back to the gold stocks, which you mentioned briefly. How are they doing right now, and where are you seeing opportunities?
Right. So yeah, so gold stocks still remain historically cheap relative to the price of gold. And that is an outcome of just sort of the stage of the market. This market has been a slow burn to get going, shall we say. And, you know, we started in 2016. That's a while ago. Um, but we had our initial, often gold markets have this two-phase pattern. So they have a go and then they consolidate and step back. So they went in 2016, they stepped back all the way through 2018, and we're starting to rise again in 2019. And then this is in our second phase. And through all of that, gold stocks have done fine, but there's a lot of upside ahead if we just look at the past and sort of, you know, how gold miners are valued relative to the price of gold. There's multiples ahead for gold miners just to catch up to historic ratios for their valuations versus the price of gold, let alone should the price of gold continue to rise. So there's a lot of upside ahead for gold miners. I really believe that. For those who are interested in the space, I mean, if you are interested in the gold space, but you don't have a lot of time or knowledge, buy a basket of gold miners. Like, doesn't have to be any more complicated than that. You can do very well with a simple basket of gold miners, whether you buy a few stocks on your own or whether you buy an ETF that is a basket, that can do really well for you. If you want to be more involved, spend more time paying attention to stock picking and then following the news and being more dynamic with your trading, there's all kinds of opportunity out there right now. We're still early enough in this market that there's tons of companies being formed with interesting new projects and dynamic management teams. There's lots of companies that have had enough money and funding over the last few years that their projects have real momentum, like they're going right now. There's projects of all stages and management teams of all stages. So if you're interested in the more speculative, involved end of the spectrum, the explorers and the developers, there's lots of opportunity there. And we're just now, I think, getting to the point where that rising tide is lifting all ships, as opposed to only lifting the very best of the best or the standout discoveries, things like that. I think we're starting to get a rising tide effect, which is helpful because it just improves the odds.
Sure. Okay, so lots of opportunities out there. And as we look at the broader commodity space, many other metals are on the rise right now, as you mentioned. So, one question that I have is, if you're an investor who's looking at this positive general outlook, how do you decide which direction to go in? Where I guess the question again is, where are you seeing opportunities at the moment if everything is looking pretty good?
Fair enough. No, it's a good question for sure. So I think for any investor, I always think that it starts with how engaged do you want to be in your mining portfolio? And if you want to be quite engaged, then you play the discovery, exploration, maybe project development, building a mine side of the spectrum. If you don't want to be as involved, then you play the mining companies. So that's the first segmentation. Which sort of side of the spectrum do you want to be on? More than it, you can play the explorers and still own some miners, but you can't play the miners and just own a few explorers and hope that that works out for you, because it probably won't. That's just not how the risky speculative exploration space works. So that's your first thing, is decide what kind of investor you are. Don't feel guilty about being one kind or the other. They will both do very well, but they both require very different levels of commitment and knowledge. So first, decide which kind of investor you are. And then you just have to decide where you are most interested in placing your bets. I mean, do you really love gold? There's lots of opportunity there. Lots of people certainly want silver coverage, either more than gold or at least alongside gold, because silver does have this, what they call slingshot effect. Slingshot effect. It's often a little, it lags gold earlier in a market and then shoots past it as the market progresses. But the base metal side of things is also very exciting. And this is, I mean, look at the price of lumber is up, whatever, 400% in the last year. It's insane, right? That's obviously not a metal, but that is an example of the commodities space right now. That's an example of demand outstripping supply, inflation's playing a role, and the prices are really rising. I mean, then you look at a 1-year price chart for copper, you look at a 1-year price chart for nickel, you look at a 1-year price chart for iron ore, these things look unreal. And so then it's a matter of just sort of deciding which segments you are most keen on. Where do you see the most upside? The electrification movement is undeniable, and there are lots of metals involved in the electrification of the world. Copper and nickel are amongst the larger markets of those metals. Then there's the smaller markets. There's cobalt and lithium and things like that. I personally don't do a lot of playing in the smaller markets because they're just riskier, more opaque, more difficult to understand. But I'm in love with copper right now. The copper supply demand outlook is very bullish. There's lots of major banks out there who are not particularly commodities inclined, who see copper averaging, $5 or $6 a pound in the next year or two. Like this is a real copper bull market. And so I think that there's a lot of opportunity to play copper miners as the price rises, to play copper developers because those projects are going to get bought out. So yeah, just think about which areas you really like to have exposure to. I mean, I think personally, I'm really into gold, silver, copper, nickel. Those are probably my first. Uranium, I'm also make sure that I'm positioned because when uranium goes, it will go. It's just very difficult to know when that happens. So I just sort of have a segment set aside in uranium in anticipation of that happening at some point. But you just sort of have to decide where you want to place your bets. And if you're a less engaged investor, again, that's fine. You can buy an ETF of copper miners, an ETF of gold miners. You can get some exposure to nickel and iron ore through a commodities mining fund. And that can be your exposure. That also really works. So just sort of decide your level of engagement, which parts of this commodity bull market excite you the most or make you think, which parts do you think have the most exciting upside, and just get yourself some position in them.
Okay, so really lots of options out there. And of course, everyone needs to do their own research. I was watching recently your presentation at the latest Meadows Investor Forum, and the title was, "Is this it? Yes, it is," which you said is based on a question that a lot of people are asking you right now. So I wanted to ask you, why do you think that so many resource investors are coming to you with that question? Why is it that people might be hesitant to believe, like, okay, it's really happening now?
Well, because this has been such a slow start market. I mean, those of us who believed in the gold market when it started in 2016, I mean, 5 years is a long time, right? And so, and in that time, we had a really nice run in 2016. We stepped back in 2017 and 18. We were going again in 2019. Then we had COVID, which caused this insane jarring movement. And it's been a bit of a roller coaster. And so, the thing with a really big bull market, is it requires generalists to rotate in. It can't just be mining inclined investors deciding that this is it and like making bigger bets. There aren't enough of us, so to speak, to do that. It requires generalist investors who don't usually play this space to say, hey, there's real opportunity in commodities right now, and to rotate some percentage of their portfolio, for funds to do that, for individuals to do that, to rotate some part of their portfolio into metals and miners. And I think the reason that I think that this is it is because that is happening. I mean, you can't go a day without reading in the business section of any news website some article about the commodities market and how hot this commodity is, or how inflation is impacting that, or how supply demand is so tight for this other commodity. This is a really common topic of conversation now. And so I think that commodities argument is very real. And so that really matters. And as that happens, and as inflation has shown up, those things, like I say, together fuel the gold argument. So I think that this is it because the generalists are coming. And I think the mining investors who have been playing this market, so entering and exiting and managing risk and taking some profit, but still waiting for the big one. Fair enough that they wonder, because there's been a lot of starts and stops, but I do think that this is it because of the generalist interest that's becoming really apparent.
And any final thoughts you would leave investors with in terms of how to navigate? You've given us a lot of advice to look at, but any last points that you would give?
Yeah, so I think it's a bit repetitive of something I said before, but it really is important that investors play in the part of the mining and metals space that makes sense for them. So if you like, it takes a lot of knowledge to play, and this applies to lots of arenas. If you're looking at biotech, or if you're looking at cannabis, if you're looking at sort of a lot of different arenas, technology, it takes a lot of knowledge to play the high risk end of the spectrum, whether it's tech stocks that are incubating new ideas, whether it's mining companies that are exploration companies who are pre-discovery. To understand that pre-discovery value proposition requires knowledge of geology and jurisdiction and people and share structure and a whole host of pieces of information. And then if you look at all of that and decide that it works, then you invest, then you still need to follow along with every piece of information that comes out, every news release, and make sure you understand it. So I just don't want investors to get burned by getting excited about an ad they see about someone who's exploring for gold and investing in that because it's a gold market, but not really being prepared, not having the knowledge base to understand how to invest in such a speculative thing. So I really emphasize that there's a huge amount of opportunity ahead in this market across the risk spectrum. You can do very well with the lower risk entities as well. And you won't have to pay attention to it on a daily basis. You won't have to trade those stocks based on seasonality or news or any of those things. They will just perform with the market, giving you leverage to rising metal prices. If you're knowledgeable and want to invest a bunch of time, then absolutely play in the exploration and development end of the spectrum. But choose the game that makes sense for you. I hate seeing investors getting sucked into an arena that isn't appropriate for them, because that can cause a lot of heartache. And in a good market, we don't need to have heartache.
Sounds like a great point to end on. Thank you so much for being here today to talk about what's going on in the metals markets.
Thank you so much for having me anytime.
And once again, I'm Charlotte McLeod with the Investing News Network, and this is Gwen Preston of Resource Maven.